Hey guys, Peter Harper, Managing Director and CEO of the Asena Family Office. For those of you who are not familiar with the business, we're a multifamily office and we advise foreign family offices on US direct investment and mergers and acquisitions. So this is the 8th vlog in our Grantor Trust Series, and we're now in the territory where we're talking about the big boys. Right? The two biggest sections within the Grantor Trust rules that generally impact foreign trusts, Code Section 678 and Code Section 679. 678 is a particular provision within the Grantor Trust rules that has the impact of treating someone other than the original grantor as the owner. So to recap, the Grantor Trust rules are 9 sections within the Internal Revenue Code that are specifically designed to attribute income that has been derived by a trust and may be distributed to some other beneficiary to the person that is determined to be the grantor. The grantor is generally someone who has settled via loan or gift some form of capital on a trust, whether that's on its original formation or at some point in the future. Right? Code Section 678 is a provision that has the impact of treating someone other than the original grantor as being the owner. And if that person becomes the owner, then the ship gets steered, income ceases to be distributed to the original grantor and starts being attributed to the new owner. So what are the circumstances in which we see this interplay working through? In a lot of foreign forms of discretionary trusts that exist, they're set up with a trustee, an appointer or protector that has the ability to appoint or remove the trustee at any time for any reason, right? And so it can be that particular provision, whether it's a succession provision, right, which says that maybe someone other than the original grantor can appoint and remove the trustee, right? So in a situation where you might have another family member that's also a beneficiary of the trust, all of a sudden has that sole inalienable right to appoint and remove the trustee. So if they could remove the trustee, they can distribute income and capital to themselves, thereby vesting the trust. Or it can be through some form of estate plan. So it might be some form of testamentary structure that says when the original grantor passes away and someone other than the original grantor succeeds as effectively as the person controlling the trust, they all of a sudden have the power, if they're a US person, to vest assets in themselves, thereby making themselves the owner, right? So this provision is relevant to any foreign family office or high net wealth, ultra net wealth individual that has a foreign structure with US beneficiaries and is thinking about how the Grantor Trust rules could impact their structure during their lifetimes or after the death of the grantor. Cheers.